Simple question, guys. Do you believe that it is the end of the world? Do you believe that what's going on with the recession, what's going on with inflation, what's going on with the conflict in Ukraine, do you believe that these are the conditions for the end of the world? If you do, then you can stop watching this video. The legendary investor Art Cashin said, if you bet on end of the world scenarios, then who are you going to settle with? So for the rest of you that don't believe that this is the end of the world, just keep this in mind. Bear markets and recessions are the biggest opportunities for wealth transfers for retail traders in history. There's nothing else like it. So in this video, I'm going to be presenting you with must-see statistics as it relates to bear markets and recessions, and hopefully try and change your perception on times like these. Because in reality, this is the time for you to keep your head down and focus on how you're going to be positioning your portfolio and your investments for the long term for when the market gets back to a bull status. So without further ado, let's get right into it. All right, so on to the statistics that will hopefully calm you down as we navigate through this bear market and recession. Statistic number one that I want to share with you: holding an S&P 500 index for 20 years has always been a guaranteed moneymaker. How long you hold on to the S&P 500 index is far more important than what price you buy into it. Crestmont Research examined the rolling 20-year returns going back 103 years. And what they found was astounding. The S&P 500 has never had a negative 20-year rolling total return. And in 103 years, there have only been two end years, 1948 and 1949, after World War II, where the average annual total return over the 20-year period was less than 5%. So again, I punt the question off back to you. Do you believe this is the end of the world? If not, then invest as usual in quality stocks and indices and keep going. Point number two, you don't need a ton of money to get rich from the stock market. And if you're not investing in the stock market, you are selling yourself short. Let's take a look at a simple investment calculator. And let's just say that you started with a modest $1,000 of an initial investment. Now let's add a monthly contribution of $500, which for most people with a full-time job is manageable. Obviously, you can cater this to your budget. And based on the demographic that watches this channel, I'm going to estimate an average of about 35 years left until retirement. If you're in your 20s, you have a little bit more. If you're in your 30s, this is about right. Now we're going to be using a very modest rate of return. The average S&P return year over year is about 12%. We'll just say 10 to be conservative. How much money do you think you'll end up with at the end of this time window? Well, let's just click calculate and find out. So you will be left with almost $2 million. And this is just with $1,000 down, $500 a month, regardless of what the stock market is doing, based on average stock market returns going back over 100 years. Now, let's just say that you got some sort of inheritance or settlement or savings that you wanted to put towards the stock market. If you up this from 1,000 to just say 100,000, but you stick to that 500 a month, and we recalculate this, your investment after 35 years will be worth around $5.2 million. And this is regardless of what the S&P 500 is doing. If you're a fan of this channel, you know that we rely heavily on technical analysis, and you don't need to be a master chartist in order to do a weighted dollar cost averaging strategy where you buy in heavier at major support points. Whereas a typical dollar cost averager who might not look at a chart is just going to buy in with $500 a month. Well, someone who has knowledge of a chart can actually put in more weight at major support levels and buy in a lot heavier, thereby exponentially increasing their investment over time. And if you want to learn how to read charts, how to evaluate companies, how to trade options and futures to enhance your investment portfolio, we have an entire beginner section in the Academy, along with our options course, our day trading course, our technical analysis course. And we also have regular Zoom calls with me where I get to address every single one of your trading pain points and answer your questions. You will find that link in the description below. Spots usually do fill up for the month before we reopen them for the next month, so go ahead and click that link if you want to apply. Would love to have you. All right, statistic number three: stocks usually perform worse before a recession than during a recession. Now, I know this might not make sense, but the stock market is forward-looking. So if we take a look at this recession chart going all the way back to 1953, you can see that in the 2 years following a recession, price returns were positive 82% of the time. Statistic number four, and here's why I say that the stock market during bear markets is the greatest wealth transfer tool for retail investors than any other instrument in any other market. If we just look at the nominal percentage values of bear market drawdowns and the bull markets that followed, going all the way back to 1956, you could see that every single bear market was followed by an exponentially more powerful bull market. So in 1956, for example, we had a minus 21% bear market, plus 86% for the bull market, minus 28% to plus 80%, minus 22% to plus 48%. And as more retail investors have entered the market, really after 1980, you can see that usually the bull markets that followed are in the hundreds of percentage points. So in 1980, minus 27% for the bear market, the bull market that followed was plus 229%, and so on and so forth. Now, stat number 5, eventually the Fed is going to stop hiking. They're not going to be hiking forever. I know it seems like it during the rate hiking cycle, but they're going to hike rates until inflation comes down. Now, usually that comes with higher unemployment, lower earnings for companies, and lower GDP. But if we take a look at every recession, going back to the Eisenhower recession, you could see that the stock market, denoted here in a dotted blue line, on every one of these charts starts to go up, starts its rally, bottoming out of economic indicators such as GDP, payrolls, and earnings. Again, that is because the stock market is forward-looking. So the Fed is not going to hike forever. And once they get to a point where inflation has come down and they stop hiking, the stock market is going to go up well before the economic indicators themselves recover. Now, most retail traders, otherwise known as the dumb money, sorry for the derogatory comment, that's not coming from me, that's a Wall Street term, usually wait for everything to recover and for the stock market to start rallying, and they are the ones that buy near all-time high prices. I just want you to think of one thing here in order to try and alter your perception and change your view of how the stock market works. When you see the stock market drawing down here, right? And we are tanking. In order for there to be sellers, there has to be buyers. So when folks are offloading their stocks and they're panic selling at the lows, someone is buying those stocks, right? That's who you want to be. You want to be the person that's ready and willing and okay with buying these stocks at extreme discounts, having the patience and the resolve, knowing that it's really going to take, on average, a year before you are green. The reason that you get these doom and gloom sayers online that say, oh, this is worse than any other time, it's going to take 3, 4, 5 years before the stock market recovers. Yes, major recessions in the past, the extreme ones, like the one that we saw in 2008 or the 2000 dot-com bubble, if you just measured high to high, so otherwise, if you bought in at the high and you didn't do anything until you saw that all-time high again, yes, in some instances, those were multi-year points. But what we're talking about here is the exact opposite of that. It's not someone who's buying in at the high, waiting the entire bear market to do nothing, and then buying again at the high or waiting until their stocks recover. The point is, I want to be the person that is buying here, and that way my path to recovery is not only exponentially positive and you get a way more violent upside, but my time to recovery is actually not that long at all. From the bottom of the bear market until you see green again, it is always less than a year. And lastly, I'll leave you with some statistics from our good friend at CNBC, Bob Pisani, who has been around way longer than me, and you can hear what he has to say about this. So before I turn over to him, if you get anything out of this video, leave it a big fat thumbs up. Leave it in the comment section below. Let me know if you have any questions regarding recessions, bear markets. Let me know when are you going to start buying stocks. Let me know what your strategy is. Let me know if you agree or disagree. I'm always down to listen, and I always want to respond and have fruitful discussions with you guys. If you want access to all of our analysis, plays, stats, courses, the Zoom calls with me, link is in the description below. Book a free call with our team. Would love to have you. And let's turn it over to Bob, and I'll see you in the next video.
And you do make serious mistakes when you start second guessing your strategy and saying, oh my God, I got to do something. That's when you make mistakes. As most people know, market timing doesn't work. You have to be right going in and going out, and it's extraordinary how many mistakes that you can make. I want to reiterate that again. It's only been 15 times since 1926 the S&P is down 20% year over year, and 2/3 of the times the following year you were made whole again. In other words, you bounced back within a year. Years where you don't bounce back dramatically are not that common. I also want to point out the direction of the S&P has always historically been up. It's up 3 out of 4 years. 72% of the time, the S&P 500 is higher year over year since the 1920s. 72%, 3 out of 4 years. And normally it goes up big. 56%, I'm sorry to be professorial, but it's important to point this out. John has all these statistics. 56% of the time, the S&P 500 is up 10% or more a year. 56% of the time since the 1920s. Only 12% of the time is it down 10% or more. So you see the market direction is up. And John, as you know, people say, well, why is that?